Hey everyone, just wanted to give a quick update based on a technical indicators that I follow. One of our indicators has turned positive for 25% position in stocks. That's just basically a worldwide index for all stocks. So that that's something you may want to just keep in mind. My gut says I don't want to do it, but that isn't the way to reduce risk and to maximize upside. So moving into stocks, 25% of a position that I might normally carry in my portfolio. So for what it's worth, and just a few other updates. Obviously, the war is very unclear as to what's going on, but we have made some technical recoveries in some of the market indicators, and the market clearly wants to go up. Whether the war can actually be over or not, it appears that Trump certainly wants this to end because of the damage that the Strait of Hormuz is going to cause to the global economies. He's trying to end it. So that's good as long as we can get a resolution and get the strait open. That's really important. Hopefully, that's where we head for whatever your political leanings may be. Getting the strait open is pretty critical for a recovery in the economies and not ending into a worldwide recession, which is where we were heading. So got to get them open. It's not open yet, so that's needs to happen. So anyway, a few other things I just wanted to mention. Private AI and private credit, private equity is interesting. Some things that are going on there. There was another Anthropic Claude update today. Some of the models are becoming so powerful they're not even releasing them because of the potential security flaws they could find. So the power of Claude and OpenClaw out there in writing software and in doing various things as an agent for you have accelerated just incredibly fast, and that's causing more software stocks to crater. Palantir dropped a bunch today and has been dropping a bunch. Microsoft, a lot of the various software companies, Salesforce are suffering, and there's also a lot of smaller companies that are suffering in the software world. And what that is causing is that's causing some private credit issues, because guess what? Private credit, private equity have 50% of their investments are invested in software as a service companies like those that I just mentioned. So there are risks increasing in that area. Fortunately, a run on them is limited by the fact that they're private and that they can cap the amount of redemption. So, and they have in their contracts, and they're slowing the withdrawal of cash. So there's not quite as fast of a liquidity withdrawal out of the markets. But that's something to be aware of. This has been happening, as I talked about last summer. This has been happening. It's accelerating at the pace that it can accelerate. So there's a limit at how fast the people can run for the exits. But this is a real issue. Where it will end up, we may only be in early innings, is my guess on this, and it will continue to be a strain. But we don't know when it could become worse and when it could really infect some of the larger banks that invested in the equity companies that are invested in these software companies, as well as many other different companies, whether it's an HVAC company that bought 30 HVAC companies across the United States and at elevated valuations. So all that stuff may come to roost as interest rates are staying stubbornly high, and the cash flow may slow down as the economy is slowing. The economy is slowing. That is continuing to be the case. The GDPs have been revised down. We're barely at 1% GDP, and the job market has been showing weakness. Hey, and guess what? Only 25% of the people that are actually unemployed collect unemployment. So the numbers you're seeing are not a real reflection of the economy, because the payoffs for collecting unemployment are usually less than actually going out and driving for Uber or DoorDash or whatever it might be. A lot of people aren't filing for unemployment because it's not paying enough. So these numbers are widely underreported, and that is reflecting that the economy looks better than it actually is. And that's been the case for a year or two now. So anyway, just be aware of those factors, and keep an eye on the markets. Gold is holding in there, and we may even get a Bitcoin signal to go long with that down the road. Not yet, but I still have plenty of it, but to actually trade the momentum there. So anyway, that's it with that. Real estate is struggling right along. April's starting out slow. March was good overall in the number of transactions, a bit of a recovery from the horrific January and February number of transactions nationwide and regionally. But March was decent, and April's starting to slow a bit just because of war fatigue. I'm sure it's got people on the sidelines. And of course, interest rates going from 6 to 6.5 is not helping. That's starting to soften a little bit. Interest rates are starting to slip back down. Hopefully that continues to improve as the real signs that the economy is slowing start to bring interest rates down. We don't want unemployment to rage, and there is that risk with AI and lack of hiring. Disney just announced 1,000 job cuts today, and once again we have the Oracle and the Facebook cuts coming as well. So anyway, a mixed bag here. Real estate hopefully will start recovering as interest rates start to slip, and we can get out of the scariness of the war and the shortages that are occurring right now as we speak in the Asia economies, where they're locking down economies and telling you not to drive and only going into work one day a week and working from home and all that stuff because they're running out of fuel. So anyway, hopefully that will improve if Iran starts really opening the strait, if Israel stops shooting people, and the U.S. can twist Iran's arm this weekend. So hopefully we will get some progress on the strait, but who knows where this could go. So anyway, that's the latest. Just wanted to give you an update with the change in the technical indicators looking a little bit better. I'm personally more skeptical, but we can't follow our heart because our heart will deceive us when it comes to stock markets. So that's the latest, and I will update you if more things change. Take care.